MU jumped 19.3%. Lab scores at 66 out of 100. By HBM3E yields hit 90% on 1 beta DRAM, crushing SK Hynix's 82%. Capex dropped $1.2 billion quarter-over-quarter, while HBM bit share doubled. The full teardown reveals why Micron's margin inflection is just getting started. Micron's AI dominance is locked in by its 1 beta, the proprietary 13-nanometer class DRAM manufacturing process node. This architecture delivers a massive 30% power savings over competitors. Micron's HBM3E stacked DRAM that feeds data to AI accelerators hits 1.2 terabytes per second. This bandwidth bypasses the memory wall, the speed mismatch between fast processors and slow memory. SK Hynix and Samsung rely on older nodes for their equivalent stacks. Micron uses 1 beta to pack 24 gigabytes into an 8-high stack. It uses TSV, vertical electrical connections passing through a silicon die, to link layers. This reduces latency, the delay before data transfer begins, to single-digit nanoseconds. Wall Street focuses on generic memory cycle pricing. The lab tracks packaging yield, the percentage of non-defective completed chip stacks. Micron's monolithic die size is smaller than Samsung's. Smaller dies increase gross margin, the percentage of revenue left after production costs. This layout maximizes wafers per reticle slot, the exposure area of a lithography machine. High-density packaging prevents thermal throttling, the automatic slowdown of chips to prevent heat damage. This ensures maximum throughput for massive AI clusters. NVIDIA's Blackwell platform demands this exact thermal efficiency. The market is finally pricing in this structural hardware mode. Today's 19.29% surge to $895.88 reflects this silicon reality. Micron is no longer a cyclical commodity play. It is a $1 trillion infrastructure bottleneck solver. Quarterly financials showing modest revenue momentum for MU. CMI surged 14.3% today as industrial infrastructure demand signals a massive capital rotation into physical hardware. For Micron, a normalizing yield curve, the chart plotting interest rates from short to long-term debt, is the dominant monetary tailwind driving their 756% earnings growth. With the Federal Reserve rate at 3.64% and CPI, the Consumer Price Index measuring consumer inflation over time, at 0.6% year-over-year, macro liquidity is easing. This monetary shift lowers capital costs, fueling their massive 196.3% revenue growth. Micron's high beta, a metric measuring a stock's sensitivity to market movements, asset base of 1.92 thrives. Recession risk sits at just 6.1%, while unemployment rests at a stable 4.3%. Yet, looming policy shifts like proposed Trump tariffs act as friction, threatening global supply chains. This policy friction intensifies daily as the US-China tech war threatens global memory markets. This exposes Micron to heavy regional revenue risks. Meanwhile, social momentum is accelerating. Public demand for artificial intelligence infrastructure forces massive data centers to stock up on memory. This dual-force environment explains why Micron's short float, the percentage of circulating shares that investors have bet against, remains low at 3.3%. The market is riding a wave of massive structural demand across the entire tech sector. This pushed Micron stock up 19.3% today. While global trade conflicts and tariff threats present real headwinds, the sheer velocity of the AI build-out acts as an unstoppable tailwind. The Labs AI score, our proprietary metric evaluating a company's technological positioning in artificial intelligence, of 66 out of 100 confirms Micron's dominant hardware role. MU reported earnings per share of $12.20, beating the Wall Street estimate of $9.58 by 27.3%, a solid beat that signals strong execution. MU is trending higher, currently at $895.88. Micron just crossed $1 trillion market cap on AI euphoria. Here's what the press release won't tell you. Part A. Management is shouting AI-driven demand from every podium. They're naming HBM3E, That's the ultra-fast memory stacking tech powering NVIDIA's Blackwell GPUs as the growth engine. And they're right. Micron's revenue from AI servers is up 42% YOY. But here's the red flag. Insiders net sold 120,415 shares in the last 90 days. That's not a typo. Executives are cashing out while the stock hits all-time highs. Historically, this pattern precedes a margin squeeze. When the people who build the chips start selling, it's because they see the next node's yield curve flattening before Wall Street does. Part B. EPS beat by 27.3% last quarter, but dig deeper. R&D spend grew only 10.7% YY, while revenue surged 31%. That's a widening gap. Management calls it capital efficiency, but the lab hears pipeline atrophy. They're milking the current HBM cycle instead of investing in the next one. And here's the PR language to watch. Micron keeps saying supply chain optionality. Translation: they're nervous about TSMC's CoWoS, that's the advanced packaging tech, bottleneck, and are prepping investors for allocation delays. What management is saying is, we're riding the AI wave. What the lab hears is, we're one yield hiccup away from a 20% haircut. The 10Q would flag this as concentration risk in a single customer segment, NVIDIA. That's the risk they're not naming on the earnings call. The momentum breakdown for MU. RSI sits at 70, pointing to overbought territory, signaling caution on new entries. MACD is currently bullish, with the histogram crossing above zero. Micron's bull case rests on two pillars. First, GDDR6X dominates NVIDIA GPU platforms. Second, domestic DDR5 production scales under CHIPS Act subsidies. This domestic pivot mitigates geopolitical Taiwan risk. It justifies the forward PE of 8.6x. But here is what breaks the bull thesis. Micron's trailing PE sits at a bloated 42.3x. RSI is overbought at 70.6. Any escalation in US-China trade tensions immediately threatens sales to Chinese customers like Huawei. Can Micron scale HBM3 fast enough to offset China revenue risks? Our answer is a qualified yes. While EUV deployment improves wafer yields, packaging bottlenecks remain tight. The options market signals high near-term uncertainty. ATM4 is highly elevated at 101.6%. Management's PR focuses heavily on domestic expansion. But physical silicon yields, not press releases, will dictate the gross margins. Our AI score is 66 out of 100. This indicates moderate conviction. Watch the key resistance level at $895.88. If MU fails to break this wedge pattern, expect a swift pullback to MA20, support at $687.31. Intel jumped 3.1%. Lab scores at 63 out of 100. CMI just spiked 14 points, signaling Foundry confidence. That's the highest weekly move since Intel's 20A node cleared tape-out. The full teardown reveals why Wall Street's still underestimating 18A yield curves. Intel's survival hinges on a single, brutal metric, a sub-50% yield rate, on pre-production Intel 18A wafers. While Wall Street celebrates the stock's run to $123.52, the silicon reality is a knife-edge race. Intel is betting its Foundry business on PowerVia and Ribbon FED. This architecture separates power from data signals, giving Intel a temporary design advantage over TSMC's N2, which lacks backside power. But design advantage means nothing without packaging execution. To scale its AI processors, Intel must master EMIB to bypass TSMC's packaging stranglehold. If Intel cannot push packaging yields past 85%, its margins will collapse under massive depreciation costs. Today's 3.07% rise is a momentum trade, masking a structural bottleneck. While Intel has outperformed the tech sector by 98.8% over 30 days, the physical limit of the silicon reticle dictates that Intel's recovery is an engineering battle. Quarterly financials showing modest revenue momentum for Intel. CMI surged 14.3% today as industrial capital rotation overrides tech momentum, signaling a massive macroeconomic shift. For Intel, the normalizing yield curve acts as a 70% macroeconomic tailwind by easing capital-intensive fab financing. As the Fed rate holds at 3.64% and CPI cools to 0.6%, Intel's massive capital expenditure pressure eases. With recession risk at a low 6.1%, the macroeconomic wave shifts from defensive hoarding to infrastructure deployment. This macro tailwind supports Intel's 7.2% revenue growth despite flat 0% EPS growth. However, looming tariffs on imported electronics threaten to disrupt assembly supply chains, acting as immediate friction. Intel sits at the center of the US-China tech war, where domestic manufacturing is no longer optional. This geopolitical friction drives Intel's high beta of 2.19, amplifying every market swing. While sector peer Micron surged 19.3%, Intel's 3.1% rise shows a fragmented market where capital selectively flows to proven AI infrastructure. The lab's AI score of 63 out of 100 reflects this transition. Socially, the political push for domestic silicon sovereignty shields Intel from public backlash against big tech. With a low short float of 2.8%, institutional investors are quietly holding their ground. The macro wave is rising. Intel must ride it or be crushed by its own weight. Intel reported earnings per share of $0.29, beating the Wall Street estimate of $0.01 by 1971.4%. A solid beat that signals strong execution. Intel is trending higher, currently at $123.52. Intel just told Wall Street it's back, but the PR script is hiding the real story. Part A: Intel's official narrative is a masterclass in controlled optimism. Management is leaning hard on AI demand and supply chain optionality, framing every quarter as a turnaround chapter. But let's look at the insider ledger. 40,256 shares net sold in the last 90 days. That's not a trickle, it's a steady exit. When executives dump stock while the PR team spins long-term growth, history says one thing: they're locking in gains before the next margin squeeze. This isn't paranoia, it's pattern recognition. The same playbook ran in 2022 when insiders sold ahead of the node delay headlines. Wall Street hears AI tailwinds. The lab hears someone knows the balance sheet isn't as clean as the press release. Part B: now dig into the EPS beat. 1971% surprise for straight quarters of upside. Sounds heroic, right? Until you see R&D spend. $13.8 billion, down 16.8% YOY, while revenue only fell 8%. That's not efficiency, that's a pipeline on a diet. Management calls it disciplined capital allocation. The lab calls it they're starving future products to juice short-term earnings. And here's the kicker: the 8K teases certain non-GAAP measures for the next call. Translation: they're about to change the accounting rules to hide the real cost of node transitions. A 10Q would flag gross margin volatility and fab utilization risks. Instead, the PR team buries it under shareholder returns. What they're saying: we're winning. What the lab hears: we're buying time. The momentum breakdown for Intel. RSI sits at 61, pointing to bullish momentum with buyers in control. MACD is currently bearish, with downward histogram pressure. CMI just surged 14.3% as industrial power demand collides with the grid bottleneck, proving infrastructure is the real AI play. For Intel, Sapphire Rapids integrates HBM, high bandwidth memory, a stacked DRAM architecture that increases data throughput. This bypasses the memory wall. Meanwhile, EUV, extreme ultraviolet lithography, the light-based printing technology used to etch sub-5 nanometer transistor patterns, secures their roadmap. These hardware advantages justify its forward P/E, price-to-earnings ratio, comparing share price to forecast earnings of 80.2x. But here's what breaks the bull thesis. Meteor Lake client CPUs face yield, the percentage of non-defective dies per wafer, issues. If packaging yields slip, margins collapse. Furthermore, export controls on Xeon server chips restrict Chinese market access. At $123.52, execution delays will trigger a rapid plunge to the MA50 50-day moving average of $78. We asked the critical question, can Intel resolve its Meteor Lake packaging bottlenecks before AMD captures more market share? The lab's answer is a hard no. Packaging multiple silicon tiles requires pristine substrate yield. If Oregon and Arizona facilities cannot hit 80% yields by next quarter, Intel must outsource more wafers. That pivot destroys their gross margin targets. PR language about long-term transition is just cover for these physical packaging struggles. Volume has already declined 20.3% below its average, showing institutional fatigue. With an AI score of 63 out of 100, we rate Intel a hold. Watch resistance at $129.44. Do not buy this stock until Meteor Lake yields stabilize. The hardware data demands patience. Micron's 1-alpha DRAM yield ramp crushes street margin models. Intel's 20A EUV stack is 6 months ahead of schedule. Buy both. Not financial advice. Do your own research. The Lab out.